Okay. Um, Here's a question about from the book about revenue recognition, and it says on January 1, 2024, Hodge Beanery received $8,000 from Kennedy Company in exchange for a coffee roaster that it will deliver to Kennedy on December 31, 2024. Assuming that Hodge views the time value of money to be a significant component of this transaction and that a 9% interest rate is applicable, how much deferred revenue would Hodge recognize on January 1, 2024? And just for your information, what the book answer is that deferred revenue should be $8,000, and that's recorded just like this: cash, debit, and a credit to deferred revenue, 8,000. Then the question comes up, well, what do you do at the end of the year? Well, at the end of the year, when we deliver the goods, we're going to recognize the revenue, credit sales, and decrease the liability for deferred revenue sales. And that's going to adjust that. But then the question comes up, well, wait a second, there was the question said that there was it's a significant component of this transaction. And I don't think that this is a requirement unless the classification on the income statement itself is a significant amount. So the net income is not going to be affected, but if you do this entry, I believe this is the correct journal entry. A lot of times people don't worry about it on the income statement, but then there are some industries, for example, where operating earnings is particularly important, and they look only at operating earnings. And in this case, if you reported this, and what this is a debit to interest expense because we borrowed, they gave us cash for $8,000 in a 9% market. Remember, that was the 9% that was given here, a 9% market. So if we had borrowed from anybody else, we would have paid interest 9% of $8,720, and we would have had interest expense and a credit to cash to pay for that. Well, what happened here is they gave us $8,000, and that's how much we actually got, plus we got to get the interest for a year. So our total sales really is $8,720, the total of these two. And at the same time, we also had interest expense. Notice how this would affect the income statement. Sales would increase operating earnings. Interest expense is a non-operating earnings account. So I think one could make the argument, and I would imagine a CFO or controller of a company, a client company, would say, hey, you have to do this because it's more correct. You borrowed this $8,000 in a 9% market. We need to recognize that interest expense. And what was the effect on sales? Well, we got $8,000 plus we got to use that money for a year, and that free use of the money actually increased the sale value to $8,720, which would increase the bottom line in terms of operating earnings, but would not affect the bottom line in terms of pre-tax income or earnings per share. So that's how I would do it. And I think that it doesn't run counter to the book because they said, well, how much did we receive up front? But this is how it would be dealt with at the end of the year.